Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we'll be diving into. Markets were mostly flat Thursday as uncertainty around the U.S. economy continued to weigh on equities, thwarting the market's attempts at recovery from a month-long rout. We'll dive into the rest of the day's market trends. Then we'll break down Nike earnings as the company tries to return to the swoosh to its glory days under new CEO Elliott Hill. Plus, the Boston Celtics are seeing a whole lot of green today after agreeing to a record-breaking sale price. We'll explore what the price tag means for other sports franchises. Well, Nike shares are jumping after reporting third quarter earnings moments ago. For more reaction, we're bringing in David Swartz, equity analyst at Morningstar. And David, it seems like people here are ready to just give them a little grace, give them a little wiggle room when it comes to Elliott Hill and his turnaround efforts at the company. But what did you think of this quarter specifically?
Yeah, expectations were definitely very low. I anticipated an 11% sales decline, and it came in down about 9%. So it was a little bit better than expected, but of course, that's still a very poor quarter by Nike standards, with the sales and earnings down significantly. But as you said, people anticipated that, and they're willing to give Nike a pass. Realistically, we've been hearing bad news from Nike now for well over a year, really going back to probably December of 2023. And so it's been a string of difficult quarters. And of course, there was a CEO change. And if things were really great, then there wouldn't have been a CEO change. So people know that there are problems at Nike. This has been certainly highly publicized. And so people know that there's not really going to be a turnaround that we're really going to see until probably at least fiscal year 2026.
Was there anything in this report that sort of showed any kind of green shoots in that regard, or do we have to kind of wait for the call? And if so, what do you want to know from them at this point?
Yeah, we don't have a lot of information yet, but it looks like the North America sales were not too bad, just down about 4% or so. So, that's not too bad in comparison with some other athletic companies have been reporting in North America. However, the sales in Greater China were certainly very weak. And Europe doesn't look very good either. So it's clear that Nike has significant problems in major geographic regions that are going to need to be addressed. And it's going to definitely take some time. We know that Nike has intentionally pulled back on a lot of its shoe franchises like Air Force and Dunk that had really become stale and oversaturated in the last few years. And there have been some new products, including Pegasus Premium, Vomero 18, that seem to be doing pretty well. But at this point, we're really waiting for a lot of new products to come out, really starting probably in fall and winter of next year.
And what about this sort of inventory clean out that they had been undergoing, right? Where they had sort of the glut of inventory as sales slowed down a little bit and they were trying to move that through the system.
Yeah, I think Nike's inventory is in better shape than it was in the past. I don't think that it's perfect at this point. Nike's inventory got really out of control about 2 or 3 years ago. It was just way too much product. And it wasn't entirely Nike's fault because there were COVID reasons and other problems that were going on at the time, shipping issues. Some of those problems I think have passed. But Nike's inventory is not in perfect shape because realistically its sales are declining. So it's hard to manage the inventory when you've got declining sales. It's much easier when your sales are increasing. So it's definitely going to take some time for Nike to get its inventory in better shape in every channel, and Nike sells into a lot of channels.
Well, and Nike has its own specific problems, and then there's the macro environment right now, of course. So do you think that it is going to really be fighting even more of an uphill battle, given what seems to be some really wavering consumer sentiment in the U.S. right now?
I think Nike's really been fighting those issues for some time. We have seen, for example, in China, youth unemployment has been high, and that's Nike's target demographic. We've seen similar problems in North America and Europe where inflation has affected consumer spending, especially for younger adults, teenagers, and that's Nike's target market. So the economic environment has never been perfect, and it will never be perfect, but I think it could be better than what it is now. We don't know exactly when that will happen. So Nike needs to manage its business, assuming that economic conditions will not be ideal. And Nike has been increasing its sales through the value channel to some degree, to the family channel, as well as trying to increase sales of its higher performance and higher priced products too. So Nike really needs to address all parts of the market.
And then finally, David, I want to ask you about tariffs. We just heard from our Brooke DePalma that the company has reduced its reliance on manufacturing from China to some extent. How much exposure does it still have there that it is then exporting to the U.S.? And how do you think it's managing the tariff risk?
Well, the vast majority of Nike's products that are made in China are sold in China as well, so that it wouldn't be affected by the tariffs directly. Nike actually imports a small percentage of its merchandise from China to the United States. However, the economic factors are still there. If the trade war causes recessions in the U.S. and China, then that's definitely very negative for Nike. And there's also a risk that tariffs will be extended to other countries. If tariffs are extended to Vietnam, that would be very damaging to Nike because it is Nike's #1 sourcing country, and it does a lot of importing from Vietnam. And so I don't think Nike can avoid those tariffs very easily. It would also affect Adidas, which has a big manufacturing facility in Vietnam as well.
Interesting. So watch this space on that front. David, thank you so much for your time. Appreciate it. U.S. stocks closing lower today, failing to build on the Fed-fueled rally. Here with the trading day takeaways, Yahoo Finance's Alexandra Canal. Hi, Ali.
Hey, Julia. Yeah, pretty boring day on markets. Like you said, markets were unable to get the job done, continue the rally that we saw yesterday after the Fed decided to hold rates steady. The Fed also maintained its 2 rate cut projection for this year. And if we take a look at where the major indexes ended up, all in the red, that was led by declines from the tech-heavy NASDAQ, down around 0.3%. We were positive earlier in the trading session. Same thing with the S&P 500. And then the Dow, honestly, we almost eked out those gains towards the end, but closing just below the flat line. And a lot of this has to do with the uncertainty narrative that's really been plaguing markets over the last few weeks. Uncertainty over trade, uncertainty over the Fed, what they will do in the future. And you guys had the chance to speak with Mike Kantrowitz from Piper Sandler. He spoke a little bit about this uncertainty, so I want to play that clip for you.
With this uncertainty perhaps persisting, I don't think this is the time to look for home runs and make big risk bets, particularly before April 2nd. I do think, maybe if there's really higher quality names that offer some stability, that's the type of stuff that we've been recommending in this volatile backdrop. And we think we're going to have quite a bit of volatility for much of this year.
It's quite a bit of volatility. April 2nd is when those supposed reciprocal tariffs go into effect. So really it's this risk-off sentiment in the market. That's why you're seeing gold continue to move to the upside. A lot of people piling into the bond market that's pressuring yields. So it's this TBD factor that's kind of clouding the outlook.
And it looks like tech underperforming again today.
Yes, underperforming. The lag 7 once again lagging again. And it's interesting if we peek under the hood to see where we ended up in the tech with those tech names. We did see slight gains for Nvidia, Meta, Tesla, but I want to turn to how much we're off of those 52-week highs, because this is a bloodbath. Pretty much all of the Mag 7 names are off about 20%. Exception being Tesla, off over 50%. We've seen some pretty wild swings for Tesla. So, the fact that we're off of these highs so much begs the question, if tech really was the savior of the bull run over the past 2 years, what will be that next catalyst? Is it a Trump put? Is it a Fed put? That's what strategists are really trying to determine, and I don't think anyone really has that answer quite yet.
No, they don't seem to. Well, speaking of the Fed put, let's talk about the continued sort of percolation of what Jay Powell had to talk about yesterday.
Yeah, so the Fed anticipating 2 interest rate cuts to come. I will say it was a bit of a hawkish tilt because there were more FOMC members who thought maybe we'll hold rates steady, maybe we'll just see 1 cut. But I dug into the CME Fed predictions, and a lot of traders are still pricing in 3 rate cuts. This has not really changed from the week prior period, but considering we got all that information from the Fed, I thought it was pretty interesting. 33% pricing in 3 cuts compared to 29% pricing in 2 cuts by that December meeting. So you wonder where the inspiration for these rate cuts is coming from with markets. Is it because they think there's going to be a further deterioration of the economy? Do they think we're going to see good news? And it's a shifting strategy strategy from the Fed too, because last year we were cutting really for good news, decelerating inflation. Now we might be cutting for bad news.
Right.
And how you play that as an investor is a little muddied at this point.
Yeah, for sure. And also, what is the inflation forecast implied in all of this that would allow them to cut 3 more times?
Exactly. Stagflation, I don't know if you can cut 3 times. So, again, none of us know. And neither does Jay Powell.
No, and he said nobody he knows either.
That makes me feel better.
I guess.
A little, at least we don't know.
We're all in this together.
Exactly, we're all in this together. Absolutely.
Thanks, Sally. Appreciate it. Stick around, much more Asking for a Trend still to come. It's a jam-packed hour. One of the most storied franchises in sports history is about to change hands for the first time since 2002. Bill Chisholm, managing partner at Symphony Technology Group, has agreed to buy the Boston Celtics for $6.1 billion. It's a new record in North American sports. And joining us now is Joe Pompliano, Yahoo Finance Sports Report host. So, Joe, I got to get your take on this deal and what it might mean for other teams and other valuations for those that might be up for sale in the near future.
Yeah, I think it was quite a surprise to a lot of people around sports business and specifically the NBA. I mean, if you think about the Boston Celtics, they're obviously one of the most historic franchises in a big market. There's no other NBA team in Boston as well. So there's a lot of really good things there. But the Celtics are also missing some fundamental things that really drive team valuations. And number one, most importantly, is the fact that they don't own their own arena. TD Garden is owned by the same company that owns the Boston Bruins, the NHL team. So they have a lease, they pay a lease agreement to the Bruins ownership group, and then they get a collection of revenue from each game, but it's much smaller than a lot of the other teams in the NBA, and they also only own a portion of their local media rights as well. So there were a few negative factors there that I think people thought would drive down the price a little bit lower than expected, but $6.1 billion is $2 billion more than the previous NBA record, and it's quite a great deal, probably driven by the NBA's new $76 billion media rights deal.
So does this then reset all the prices? I mean, were there also some sort of idiosyncratic things here? It seemed like the team was in high demand. I know there was a group led by Bain Capital's chair, Stephen Pagliuca, who was also very interested in buying it. Do you expect to see figures to just go higher from here?
Definitely. I think more importantly, though, it sets a new floor for the NBA. It's no secret that the NBA has been trying to add 2 expansion teams, presumably in Las Vegas and Seattle over the last years and soon to come in the next few years. But they were really waiting on the Celtics sale because that is now going to be the floor, the entry price for an expansion team. So if someone wants to come in and buy an expansion team, the floor is now at $6.1 billion and potentially even higher if we go out a few years into the future. So Adam Silver and the NBA have to be thrilled about this, and Pags and other people like that, while they may have missed out on the Celtics, will now have the opportunity to either buy one of the expansion teams or potentially another NBA team, because other owners are certainly looking at this and seeing the multiple that the Celtics were able to get and are probably excited about that too.
Yeah, I'm sure that they are. All right, we got to stick with basketball. We got to go to the NCAA, though. Pros to college. The tournament kicking off today. I know a lot of people have it on their second screens in the office, and there, of course, are big bucks involved for the teams who make the field, even more on the line for teams that win a few games. So what are you watching in terms of the business of March Madness?
Yeah, March Madness is a really unique tournament because it drives almost all of the NCAA's revenue for the year. So it's by far their biggest event because it's their tournament. They own it. They make a lot of money off of it. They obviously have a big TV deal, but they also make a lot of money off the sponsorship side of things too. Over $1 billion in commercials will be run during March Madness, which is, if you think about the major sports leagues, that's more money in postseason commercial revenue than every other league outside of the NFL. So that's obviously big and important. But like you mentioned, it's great for the schools too, because the structure works very similar to what you would see for the college football playoff, for instance, where you get paid units for making the tournament, $2 million in this case, and then you get paid additional units every time you win a game. So the units are important because they don't necessarily go to the school, but they go to your conference unless you don't belong to a conference like Notre Dame. That money then gets redistributed to all the schools in the conference, depending how that conference has it set up. But it can be a huge payday for other schools in the conference who also don't make the tournament. And coaches, of course, have incentives in their contract that can drive their salaries higher too.
Very interesting and complicated. Joe, thank you. Appreciate it. Be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report. They drop every Thursday at 5 p.m. Eastern. Here's a look at the latest episode.
The challenge that we're continuing to face in the industry is, okay, how do you get brands and companies and networks to invest heavily across the board while also still going deep with each of their relationships, because otherwise things turn pretty transactional and feel very surface level. And that's where you start to then, okay, get a little back into your old ways and it doesn't feel right. So it's a really interesting tipping point, I think, for the industry right now on how we collectively handle all of this, all these newfound eyeballs and interest in the players and in the league and in the team. But how do we continue to make it more than just, hey, here's some cash for these services?
Short sellers are cleaning up to start 2025, and it's largely because of the Magnificent Seven. Yahoo Finance's Josh Shaver joining me now with a closer look in our chart of the day.
Short sellers are having quite a 2025. So, of course, short sellers would be people that place a bet on, essentially a bet on a stock to go down. If the stock price goes down, those traders usually profit. And what we're looking at here is some massive profits for short sellers across the Magnificent Seven. So you can see here, people that have shorted, or traders that have shorted Tesla stock, have made $10.8 billion. And then you take a look at Apple, that's almost $5 billion short sellers have made. Nvidia, again, over $4 billion. So those three stocks being the largest here, but over $1 billion for the likes of Alphabet and Amazon. So interesting to see how that sort of dispersed. And then overall, I think what we're seeing here is just a market narrative shift. This is data from S3 Partners. The last time I spoke with S3 Partners a month ago, I was asking them how much short sellers were losing on stocks like Palantir, stocks like AppLovin. That was just in the middle of February that a lot of short sellers were losing money on popular AI names. Now you're starting to see short sellers making a significant amount of money on some of the largest stocks in the market. Again, all 7 of these companies are actually now down on the year. And so you're starting to see just a little bit of a market narrative shift right now. Of course, being short Tesla is normally a very popular trade. Being short some of these other names, maybe not as much. So it'll be interesting to see how that sentiment sort of shakes out as we maybe come out of this drawdown that we've been in markets.
Yeah, and also makes you wonder if we could see short squeezes, if there are any pops in some of these stocks. We shall see, Josh. Thank you. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.